Welcome back, everyone. I hope you enjoyed the first session on supply chain challenges, and thanks for turning back in for our next discussion about China and the country's common prosperity policy. If you are just joining us for the first time today, I'm Mark Duggan, the Trione Director of SIEPR, and I'm so glad you're with us for this part of our annual economics summit. The common prosperity policy is having a major impact on businesses and investing in the world's second largest economy, China. Our panelists will help put economic prosperity in a bit of historical and political context, and they'll dig into the goals and longer-term implications of this policy. Moderating the session is my friend and colleague here at Stanford, Darrell Duffie. Darrell is one of our senior fellows at SIEPR, as well as the Adams Distinguished Professor of Management and Professor of Finance at the Stanford Graduate School of Business. Darrell is a past president of the American Finance Association, and he chaired the Financial Stability Board's Market Participants Group on reference rate reform. He was also a project advisor of the G30 Working Group on digital currency, and he co-directs the Hoover Institution's study of the global implications of China's central bank digital currency. Darrell's research focuses on the design and regulation of financial markets, and he's written several books on banking and markets. Darrell is going to introduce our panelists and then lead a Q&A following their presentations before we open up to your questions. So with that, let me turn things over to you, Darrell. Thank you so much for being with us, and take it away.
Mark, it's always such a pleasure to work with you. And I'm planning on a really lively session today on China's economy. So we have two very, very distinguished speakers, leading voices on what's happening in China, its economy and its finances. One of our speakers, Dr. Qian Wang, is the chief economist and Asia and Pacific global head of VCMM, which is the Vanguard capital markets model at Vanguard Investment Strategy Group. Qian actually oversees Vanguard's market forecasting and simulation. Before that, Dr. Wang served as the director of research at one of China's largest investors, if not the largest investor, CIC, the China Investment Corporation. And she was the chief China economist and head of Greater China Macro Research at JP Morgan. Earlier in her career, Dr. Wang was on the faculty of the Chinese University of Hong Kong, where she did research on Asian economies with a focus on China and on international capital markets and corporate finance. Her research has been published in top academic journals. In fact, Qian got her PhD right here at my school, Stanford's Graduate School of Business. Our second speaker today, Dr. Nicholas Lardy, is senior fellow at the Peterson Institute, and for many years considered the expert leading scholar on the Chinese economy. He joined the Peterson Institute in 2003, coming from the Brookings Institution, where he was a senior fellow from 1995. And before Brookings, he served at the University of Washington as the director of the Henry Jackson School of International Studies from 1991 to 1995. Nick has been writing so many books, it's impossible to describe all of them, but I can tell you the two that I've been teaching in my own course on China's financial system here at Stanford. Most recent being The State Strikes Back, The End of Economic Reform in China, published in 2019, and Markets Over Mao, The Rise of Private Business in China, published in 2014. Nick is a member of the Council on Foreign Relations, and he also serves on the editorial boards of Asia Policy and the China Review. Nick's PhD in economics is from the University of Michigan. So I'd like to start with you, Nick, if you wouldn't mind giving us some opening remarks, and then I'll turn to Qian, and then we can open it up for discussion among ourselves, and then we'll take some questions and answers from the audience. Please, Nick.
Well, thank you, Darrell, and thank the organizers for inviting me. The announced topic is China's common prosperity policy, and I'm sure we're going to move far beyond that topic, but I'll begin with a few remarks on this policy. What's its origin? What does it mean? I'm an economist, so I think we have to recognize there are three different elements of the income distribution in any society. The first is what some call the primary distribution. What's the distribution of wages? And China is pretty unequal. They have a few people at the top that are highly educated in highly paid jobs. And they still have a large number of people in the countryside that they're not quite at subsistence agriculture, but something close to it. So the primary distribution is very unequal. But the next thing we want to look at, of course, is what is the role of the government and what you might call secondary distribution or redistribution. And that means we have to look at the tax side and the expenditure side. And in this regard, I think China does not come out very well. And I'll make some comparisons with the United States. Both China and the United States have progressive income taxes, but in China, the role of the personal income tax is very small relative to GDP. It's about half as much as it is in the United States. Well, they have a progressive income tax. It's not very powerful. Relatedly, on the tax side, China does not have any taxes on capital gains. It does not have a property tax. And for most Chinese households, a very large share, if not the majority of their wealth, is held in the form of property, and property values have been going up fairly regularly for at least a couple of decades. But those gains are not taxed. Even when you sell, you don't pay a tax. And China relies primarily on a value-added tax, which in China, as in most other places, is fairly regressive. In other words, it hits lower income people harder than high income people. So on the tax side, China does not do very much to equalize the distribution of income that's coming out of the labor market. Then we have to look at the expenditure side. And here again, I think China falls short. Prior to the pandemic, the United States transfer payments to individuals accounted for about 15% of personal disposable income. China's been at the level of around 8%. So China's redistributing in expenditures about half as much as the United States. And then we need to look at, well, what happened in the pandemic when the economic situation deteriorated? Transfer payments in the United States in absolute amount increased by about a third, and they became equal to almost 20% of disposable income. In other words, for the average family in the United States, 1/5 of their income was coming from various forms of transfer payments from the government. China did virtually nothing to increase transfer payments during the pandemic. So whether we're looking at the level of taxation through the progressive income tax, or we're looking at the expenditure side, China doesn't do very much to achieve common prosperity. Finally, a third element we might want to look at is philanthropy. How much money is getting redistributed through better off families and households contributing to various kinds of charitable organizations that then use the funds to support people in need. Well, in the United States in 2020, charitable contributions were about 2% of GDP. So not a huge number, but it was about $470 billion. China, the most recent data I've been able to find, philanthropy is about 0.2% of GDP. So my conclusion is, in a nutshell, that the Common Prosperity Program in China is a bumper sticker. It is important because it recognizes that income inequality is very high. It's a matter of greater and greater popular concern. And so they put out this program calling Common Prosperity to give the impression that the government is actually doing something about it. In reality, I think it's a slogan. There are very few policies that are actually achieving common prosperity in China. They had, for example, an experimental pilot program on housing taxation that started 10, 12, maybe even 15 years ago in 2 very small geographies. It never went anywhere. Now they say they're going to begin another trial program to tax real property, houses, flats, apartments, condos, whatever you want to call them. So I think China has a strong program verbally about common prosperity, but it's not matched by specific concrete policies that would alleviate the huge disparities in the distribution of wage income.
Terrific. Nick, I'm going to turn now to Qian. If you finished your opening remark, and I'm going to ask Qian to offer us some opening remarks. Would you please, Qian?
Yeah. Thank you, Darrell. First, I want to say thank you so much, Professor Mark Duggan, for inviting me to the SIEPR Summit and also this session to talk about such an important topic. In fact, I would say it's such a privilege to be in the panel with Darrell. You know, you are my professor 20 years ago, and more than 20 years ago, and also Nick, the leading expert on Chinese economy. Now, you know, I think to a certain extent, I would agree with a lot of you know, what Nick just said, right? I think China is tackling the right issue, right? That is inequality. But I do agree with Nick that they need to take the right approach as well, right? If they want to achieve that goal. Now, the thing is, you know, when we first, you know, common prosperity was brought up, you know, and hitting the news headlines a lot last year. But then, you know, when you think about it, this is nothing surprising. There are two parts of that phrase, common and prosperity. Now, in fact, that's the two goals we always have in economics, right? Equity and efficiency. You know, sometimes the two go hand in hand, but most of the time there is a trade-off, and policymakers have to choose which one to prioritize. In fact, I would say when you look back in 40 years ago, say in 1978, when China decided to start the reform and opening up, I would say all Chinese were quite equal, but they were equally poor. So that is common poverty, not common prosperity. As a result, I think the reform really prioritized growth. You know, most of you know the famous quote from Deng Xiaoping was, let some people get rich first, right? But there is a second part. He also added that then those who get rich first could help those who lag behind so we can get rich together. You see, that's already common prosperity. Now, after 40 years of faster growth, the reality is that the income and especially wealth inequality is very high in China, no matter how you measure it, right? It's not only threatening the sustainability of economic growth in the longer term, but it's also threatening social stability and ultimately, I would say, political stability. So the government do feel the urgency, right, to narrow the income and the wealth gap. So in the end, common prosperity is nothing new. But the priority has shifted again to most common, right? The equity part. So to a certain extent, a lot of the policy moves last year can be explained by this change. You know, of course, there are a lot of you know, several other goals in addition to this. You know, maybe we can you know, touch upon that later. You know, including financial stability, you know, carbon neutrality, data security, right? So China no longer cares just about the pace of growth, but emphasize more on the quality of the growth and also risk control. Now, of course, common prosperity is a long-term goal and maybe the ultimate goal. But I think to achieve that goal, I think there are a few things policymaker needs to get right. Now, there are three things in my mind. First, I would say, is the success of common prosperity really hinges critically on a subtle balance between the growth and the redistribution strategy. Now, the risk is that, you know, in China, the policy decision framework is highly centralized at this moment. So it's very easy to lose the balance and overemphasize on the equity side. That could dampen, you know, the incentive for business entrepreneurs, right, especially in the private sector, to continue to invest and innovate, which in our view is the most important driver of China's productivity growth in the long term. So growth strategy cannot be ignored. In fact, I would say it may be much easier to share the pie when the pie continue to grow larger. And the second I would say is that a smooth policy implementation is also very important. Unlike the centralized policy decision framework, China's policy implementation framework is very decentralized. Just to think about various regulators rushing to announce policies last year at the same time. And the problem is that now, because policymakers are trying to achieve multiple goals at the same time, right? We just talked about that a little bit earlier. Then some of them may actually run at odds with each other and create confusion for the regulators as well. The result could be uncoordinated and overly aggressive campaign style policy implementation. Now, together with poor communication with the public, that is actually what's causing the panic and volatility in the market last year. Now, the third, the goal is right, but the most important question is how to achieve that goal. Actually, I think Nick mentioned about the labor market. He talked about the government spending revenue, and also he talks about the philanthropy. In my view, I would say, the most important inequality in China is really the rural-urban gap. And a better way to narrow that gap is not strengthen the government intervention or social mobilization, but instead we should narrow that gap through further deregulation and also market reform. And there are two specific reforms I had in mind. One is household registration reform, and the other is the land reform. For many years, thanks to the booming manufacturing, construction, and also low-end service sector, income from rural migrant workers has increased significantly. But that's not enough. Well, certainly government could increase spending, for example, on education in the rural area. But I think the more fundamental issue is that under the household registration system, migrant workers, they are not eligible for apply for certain jobs, to buy properties, and their kids are not eligible to go to city schools with better quality of education. That further limits their human capital accumulation and also social mobility in the future. So while more fiscal spending definitely would help, I think what is needed the most is to reform the hukou system to increase the mobility of rural residents and their family and allow them to have the same access to the resource and opportunities as the urban residents. Also, I would say the rising wealth inequality between the rural and urban residents is also due to the current rural land system. In China, farmers do not own land. So when land is taken away from them, they receive very little compensation, such as the price of the crops on the land. Now, the cheap land was in turn developed into expensive real estate projects. Of course, local governments and property developers profit a lot from that. And when urban residents buy them, it also becomes the main source of wealth accumulation for them. That actually contributed to the ever-rising wealth gap. Over the past 70 years, China had 2 rounds of land reform. The first round was in the 50s. Land was taken away from landlord and owned by the government while farmed collectively. It does not end that very well. But the second round in the late 70s was a huge success. Even though the land was still owned by the government, the rights to the farm actually went to the individual households. That provided a strong incentive for farmers and jump-started the fast growth in the past 40 years. Now I think it's the right time for another round of land reform where China should let the farmers own the land, which could be the most important property and wealth for them. So putting everything together, I would say common prosperity is nothing new. It's a right goal, but China just need to strike the right balance and take the right approach to achieve that goal.
Thank you, Qian. I expected this was going to be a lively session, and it's already starting off that way. I want to come back to common prosperity in just a moment, but I think participants here at SIEPR would be very disappointed in me if, with 2 top experts on China's economy, like Nick Lardy and Wang, that I didn't ask them about implications of the recent events in international security in Eastern Europe vis-a-vis China. So maybe, Nick, if you wouldn't mind, there's been a lot of speculation in the last couple of days, especially, that these sanctions that have been imposed on Russia could be blunted or softened by help from China. And maybe as a way to bypass the sanctions or avoid them. Do you think there's any merit to that speculation? And if so, how might that happen?
Well, I think Chinese institutions and financial institutions in particular are likely to, by and large, comply with the sanctions, but quietly. They're not going to put out a press release saying they're going along, because China is basically opposed to sanctions. They've been sanctioned repeatedly by the United States. So in principle, they don't like sanctions. So that's their kind of going in position. But their most important foreign policy principle is, national sovereignty, territorial integrity. So they certainly have not supported the Russian invasion of Ukraine, and they have said repeatedly there should be a negotiated settlement. Now, they haven't called it an invasion, apparently, but I don't attach too much significance to that. The thing you have to keep in mind is that China is not very dependent on Russia. There's been an increase in their trade with Russia in recent years, but it still accounts for only 5% of China's total foreign trade. You may read the numbers, 200 billion, 200 and something billion trade, and it sounds like it's a big number. China's trade last year, imports plus exports, was $6 trillion US dollars. They are deeply integrated into the global economy. And I don't think they're likely to try to do large-scale workarounds of the sanctions to help Russia, because they could become subject to tougher sanctions, which would have a dire effect on them. They're much more vulnerable if their banks get cut off from SWIFT and they're subject to more restrictions. It would impose a very high cost on them. And the gains that from this 5% trade with Russia are just too small to take that kind of risk. I'd make one final comment, and that is I am firmly in the camp that when Putin and Xi Jinping met just before the start of the Olympics, and they had this announcement about their new friendship or all the verbiage, I think the Chinese tended to believe Putin's statements that he wasn't going to invade. And when he did invade, I think Xi Jinping, the president of China, felt that he'd really been played by China. They had thousands and thousands of Chinese citizens in Ukraine that they couldn't start getting out of the country until the 27th of February, several days after the invasion began. So I think this putative alliance between the two countries is now much more fragile than it had been. There may be some minor cases or some smaller institutions that are willing to try to continue to work to facilitate trade, but I don't think it's going to be on a very large scale. We've already seen that quite a number of Chinese banks are no longer issuing any letters of credit to finance imports from Russia. So China's imports of coal and certain other commodities are declining rapidly. So I think the sanctions, as I said at the beginning, will by and large be followed, but quietly.
Thanks, Nick. I also followed your comments on this on CNBC, and I'd love to engage with you at another time in more depth on this. I should remind our audience as well that we have a question function by which you can supply questions in the next few minutes, and then we will come back to you in 15 minutes or so and come to some of your questions. Chen, do you have any thoughts on this issue of whether China can be of assistance to Russia at the time at which it's been sanctioned?
Well, Darrell, I would largely agree with what Nick just commented. I would say, in fact, from an economic perspective, China is actually working on very tight rope at this moment. Now, the thing is, over the last several years, we do see that the bilateral trade between US and Russia actually has increased quite significantly, right? So bilateral trade actually almost doubled after the US-China war. And now Russia is the second largest oil provider to China. I think this is China trying to diversify the friends pool, right? And they, of course, trying to diversify the supply of those key resources. But I think, at this moment, China actually risk damaging the relationship with the West, right? Especially with Europe, where actually China need that relationship with Europe the most when, the US-China tension seems to be going to be persist. Just think about how much time and efforts China has been spending on that European and China investment deal, which has not even been approved yet, right? So I think that's where China will have to be very cautious about, what to do and what not to do here.
Thanks very much. Okay, so coming back to this issue of common prosperity, Nick, a few moments ago, you called this essentially a bumper sticker. Yet, in 2021, China's government said that, and including President Xi, said that part of the Common Prosperity Program would be addressing some of the wealthier tech firms. And there was a significant amount of wealth that was knocked down in the tech sector in the tech crackdown of 2021. Almost $1 trillion of equity market value in China's stock market was reduced, with some of the tech firms being encouraged to, or at least they ended up donating money, which seems kind of in line with common prosperity. How do you view the events of 2021 and the tech crackdown? Is that part of common prosperity, or was it just something that was conflated with common prosperity?
Well, I think that's a very good question. I think there's some conflation and there's some link to common prosperity. And you're absolutely right. Jack Ma and a few of the other billionaires lost a lot of money as the stocks they owned declined in price. But that money didn't go to poor people or to new social programs in China. It was just a net loss of wealth of a handful of the richest people in China. And it is true, as you mentioned, a number of companies, of the big tech companies, have announced that they're giving money for social programs and private philanthropy and so forth. But the amounts are still quite small. You read the numbers, 10 billion RMB, 20 billion RMB. Well, this is 120 trillion RMB economy. So at least from what I've seen so far, the amounts that are being donated to social programs, of course, the companies that are doing this want to get a lot of credit, and it's portrayed as a big move, but it's not enough to move the needle on the incomes of China's poorest people. And I would agree very much with what Qian said. They do have social programs for retirement and hospitalization and so forth and so on. But the migrant workers, which are almost 300 million people, by and large are not eligible to participate in these programs and don't get very many benefits, like unemployment insurance. They don't get unemployment insurance. So if you really wanted to improve the welfare of the bottom of the income distribution, you'd have to make some fundamental changes in the way migrant workers are treated in China. So I think, maybe Xi Jinping had two goals. He wanted to cut some of the big tech entrepreneurs down to size, like Jack Ma and a few others. And so they took a big hit to their wealth. It's not as if they're poor now. And he wanted to tie it into common prosperity, but I'm a little skeptical it'll make that much difference.
Thanks very much, Nick. Qian, I know you've been following events in China with respect to the regulatory tightening that's been occurring over the past, I would say 2 to 3 years, but it's been particularly degree of tightening over the past year, and it's related in fact with the with the tech crackdown, but it's much broader than that. Mm-hmm. And it seems that the People's Bank of China and the fiscal authorities, Liu He and company, they seem to be trying to calibrate how much tightening can China's financial system and its operating companies take before they start getting so tight that there's a recession. And on the other hand, China has 270% debt to GDP, and they need to reduce the debt. So how do the authorities in China calibrate this tightening so that they get a soft landing, not a hard landing?
Yeah, I mean, Darrell, I think that's a tricky part of a policymaker in China when they suddenly get all the policy goals all together, right? Because I think, a few years ago, I think we are mainly trying to balance between growth stability and financial stability. And last year, you get additional, goals such as, social risk, right? And then common prosperity, data security, strengthen the regulation for the tech companies, right? So they are fighting multiple battles at the same time, right? And then actually it's very difficult to, get that kind of a subtle balance. I think last year is interesting because last year, because of the low base effect, it's very easy for them to achieve that growth target. They say, above 6%, but in fact, they get over 8%, despite all the tightening, despite, below trend sequential growth pace because of that low base, right? So they didn't worry so much about the growth stability last year. That's where they actually pushing out and targeting all the industries, so you mentioned about the tech industry, but actually financial property sector, for example, is the sector that was hit the most because it was both a threat to common prosperity as well as financial stability, right? So we estimate that last year, it's almost like 50% of the economy, the sectors that actually was being regulated, tightened, right? So we actually estimate that, for example, a property downturn will actually shave about 2 percentage points of the China headline growth. Now, of course, I think the question come back is say, okay, then will there be a hot landing? Will there be a sudden collapse in the financial system? I think we don't need to worry that much about it. Because I think, the government, what they will do is that Chinese government is the most programmatic government in the world. Whenever they see that they have done too far, right? And then they have this kind of very strong error correction mechanism. Whenever they feel they have done too far, they will immediately start to adjust, fine-tune their policy and shift their priority. So you clearly see that over the last several months, the growth stability has become the top priority now, right? And then we actually see some relaxation of the regulatory policy tightening. We actually also see, for example, monetary policy. In January, we saw this record high credit extension, 6 trillion in total social financing, right, in January. So I think that actually provides the downside for the economy. I don't think you need to worry that much about the hard landing, but I think the tricky part right now is that there's not much real demand from the economy, right? So the problem is lack of credit demand. So especially in the private sector. So given that, I would say, we have about say 5% growth, you can get it, but there's not much upside either.
Thanks, Qian. Nick, with respect to this tightening, my students have studied your work in State Strikes Back, your 2019 book, and some of your Peterson Institute blogs have made it clear that as the state has been cutting back on leverage in the economy, they focused most harshly on the private sector rather than the state-owned sector of the economy. Can you help us understand the implications of that for common prosperity and prosperity in general in China? The fact that the regulatory tightening is not symmetric between state-owned and private-owned enterprises?
Well, I think, the basic reality is that private companies on average are, as measured by return on assets, are twice as efficient as state companies. And for many, many years, the share of investment undertaken by private companies was going up. But in the last 6, 7, 8 years, that has plateaued off, and state companies are getting a larger share of credit, and they're less effective at utilizing that credit, and that tends to pull the growth rate down. It tends to reduce the rate of growth of employment because state companies are very capital intensive. They generate many fewer jobs. And so the increased role of the state, I think, is holding back China's economic growth. It's holding back the growth of personal income. And Xi Jinping has always been saying, since he came to power in 2012-13, that we need to have a bigger state sector. So the main trend for 30 years was the state sector was shrinking, was being outcompeted. But now it's having a bit of a revival. It's gotten better access to credit. But I think it's one of these trade-offs that Qian was mentioning. You may have more political control because you have a bigger state sector, but you're paying a price in terms of slower economic growth. I think now China's growth is below what economists would call their potential growth. I think if they had a more efficient allocation of credit and capital more generally, they could continue to grow at 6, 7% for quite, maybe another decade or so. But instead, they're trending down towards, as Qian said, maybe something in the neighborhood of 5%, maybe a little bit more. So they're paying a price for preserving a relatively inefficient state-owned economy.
That's general prosperity, but wouldn't some in China in favor of the state strikes back policies say that as far as common prosperity, this is benefiting China by reducing the fat cats that are benefiting in the private owned sector? Doesn't that level out income across the economy, even though it slows general growth?
I don't think very much. I mean, the big tech companies do have too much market power, and cutting them back, maybe they didn't do it in the most nuanced way, but cutting their power back certainly could be justified in economic terms. But we need to keep track of the fact that these big tech companies are a very small slice of the Chinese economy. There are 20 million private companies in China, and a lot more, household businesses. And so a lot of the attention in the crackdown has been focused on 6, 7, 8 of the tech companies, or what some people call the platform companies, and the wealth of the founders of those companies has been curtailed. But I think we need to take a look at the broader private sector.
Yeah, I think I can add something here.
Good.
I think the impact, right? How does this impact the general growth, the economy? I think it also depends on how the message is being interpreted, right, by the entrepreneurs, the private sector. I think if there's a lot of debate here. Right, the government was saying, and many of the researchers say, cracking down the tech sector is really just trying to strengthen the regulation, right? Because previously it was probably too loose, or there's some loopholes. So we need to, improve that regulatory environment. And also, the purpose is say we want to encourage, competition, right? So this is an antitrust, movement. Now, if that message is being interpreted in the right way, then I would say private entrepreneurs, they will be adapt to this new, tighter regulatory environment, and they will continue to invest, continue to innovate, right? So that's a good thing for the long-term economic growth. We actually found that in the long term, continued and faster, privatization reform, for example, will add more than 2 percentage points to China's potential growth, in spite of weakening demographics, dynamics, as well as a more hostile external environment. However, the risk is that those policy moves may be misinterpreted, right? So even the state media and the government recognize that risk. So for example, I do see that the state media coming out and also policy leaders come out, then they say, now those moves are not about not wanting capital, right? And they repeatedly emphasize that private investment is critical, right, for national goals such as social development and innovation, right? So to a certain extent, I think the risk is, the risk is indeed there, right? That's uncertainty. And I think so the long-term impact is still somewhat, unclear. But I think one thing I would say is quite clear is that uncertainty is not a good thing, right? There are people have different opinion means uncertainty, and uncertainty will make business intend to say, let's wait a bit. Let's wait until a low uncertainty environment to invest. And that actually delays the capital deepening, and that delays the innovation, which is not going to be very well for the overall economy.
Terrific. Well, actually, I had a bunch more questions to ask, but I want to make sure that we have a chance to get some questions in front of you too from our SIEPR participants today. And I'm seeing some good ones rolling in. So let me try one, starting with Nick. There's a question from Miles Hu that reads, has China done enough to cool down the property sector? And if there's no hot property sector, what keeps the rural areas of China motivated to save and to invest? Nick, do you have a view on that?
Well, this is another example of what Qian was talking about, the trade-off. For years, the external critics were saying China had too much credit expansion, that debt to GDP was going up to unsustainable levels. So then they started cracking down on the most egregious sector, which was property. And the result is that, the property sector slows down, growth slows down. People are talking about, maybe a recession. So it's a tough situation for policymakers. I think they have done reasonably well. They've sent a very strong signal that leverage in the property sector is not going to be protected. I think if you look at Evergrande, they're going through a restructuring. It's not very transparent, but I think the principal owner of that company and the other major shareholders are going to have their equity wiped out. And I think most of the people that were buying property through that company are probably going to get their properties delivered, maybe with some delay, but the property sector is not collapsing. So I think they've done a reasonably good job. There's no way you can kind of slow down the credit going to that sector without a few casualties emerging. And the other thing to keep in mind is that China has thousands and thousands of property developers. Evergrande is one of the biggest, but there are plenty of property developers that are not so overextended, have not borrowed excessively, and probably are going to continue to do quite well.
Qian, do you have a view on whether the attempt to control leverage in the property sector has been too aggressive or not aggressive enough?
Well, I would say first, you already see the policy start to, ease a little bit on the margin, right? So, one thing I would say, yes, the overall direction is not going to change. They are going to continue to maintain this tight regulation, especially with regard to housing is for living, not, speculating, right? So the direction is that it's not going to be like 180% turn towards easing, no, right? But on the margin, you already see some easing, for example, from several local governments start to lower the down payment ratio for mortgage purchase. And the central bank, continues to say, oh, we need to protect reasonable liquidity and credit demand for developers and also home purchaser, right? So I think there's that kind of a marginal easing already going on. So that should provide a floor, right, in the property downturn. Probably not now, but maybe later this year. But one thing I do want to highlight a little bit is that the property downturn we are seeing right now is not just because of the policy tightening. So the property downturn is both cyclical and structural, right? So from a structural perspective, you think about it, I would say China's property sector will run into oversupply, in aggregate level, right? Probably in a few years. Now you think about China. At this moment, home ownership is over 90%, right? And then you have like a living space per person, it's almost 40 square meters per person. Both are much higher than what we see in the developing country. Now, on the demographic side, working age population has already declined, since 2012, with fertility rate of 1.3, which is even lower than Japan. You're going to have total population start to shrink. That together with, this kind of, slower urbanization rate, and also the government's continued crackdown on investment, speculation, demand, you're going to have this kind of oversupply situation, especially in smaller cities where you expect less population inflow or even outflows, right? So I think we need to recognize that structural downturn in the property sector. So I don't think property sector will be the growth driver for China down the road. The question, come back again is, then what is driving China's growth in the future, right? I think China is working very hard, trying very hard to find the new growth driver, for example, green investment, right? Like manufacturing upgrade, right? So we move up the value-added chain in the manufacturing sector, or there could be, also continue the spending on infrastructure or hardcore technology, right? But ultimately, I think it still come back, on the supply side. I would say capital dependence is one thing, but continued human capital accumulation as well as productivity growth coming from innovation. And that should be driven by, the entrepreneurs, animal spirit. That's the most important thing.
Thanks, Qian. I see a really good question from Peter Liu, which seems to be asking whether we're seeing a new kind of example of the famous iron rice bowl in China related to the COVID crisis. His question reads, will the efficiency and effectiveness of distributing transfer payments to needy people be considered a key factor when considering the support for the general population during the COVID crisis of the last 2 years? Nick, is this a form of effectiveness of common prosperity, or do you think this is just another part of the bumper sticker story?
Well, I don't think there has been a big increase in transfer payments to the population during COVID. And it's barely gone up. And in part, that's because the number of cases in China has been quite small. And yes, there have been lockdowns in parts of cities for some periods of time. But in most of those cases, people that have jobs in urban areas are continuing to draw their salaries, so that, they don't need a big unemployment scheme to take care of those people. I was very, very struck a week or two ago when the New York Times had some charts that showed the cumulative number of deaths per 100,000 people in a number of countries. Your chance of dying from COVID in the US was 1,000 times more than your chance of dying in China. So, some people have criticized their zero COVID policy, but I think in terms of its saving lives, it's been a brilliant success.
Jen, any views on transfer payments and relief during the COVID era? Have the poor people of China benefited from China's approach here?
Actually, I think, Nick was correct. There's not much transfer payment, and people working in the city, they keep their job, right? And then even though there could be underemployment, but they still get paid. So I think this is somewhat similar to, what you see probably in Europe. They have the furlough, program. But I think who really suffered is really the migrant worker, right? Migrant worker. Especially because the zero COVID policy, that's been hurting the face-to-face intensive service sector, right? Usually that's like the low-end service sectors, restaurant, hospitality. And then when those businesses shut down, those migrant workers lose their job. They don't have any social transfer payment. Then they just went back home in the rural area. And then their unemployment, they lose job, are not even included in the official unemployment data, right? So I think that's the group of people that's actually suffered the most, during the pandemic. So yeah.
Qian, are you connecting this back to the hukou system that you spoke about earlier, that these migrant workers not having permissions to live in the cities and being forced to return are being especially hard hit?
Yeah, I would say so, right? I mean, I would think, the thing is, they just do not enjoy the same kind of unemployment benefit, like the urban resident, right? So if they could actually have the same access to the same resource as urban, resident, then they probably won't suffer that much. I mean, right now, I think the zero COVID policy, yes, it really helped with the health, but there is significant economic cost coming with that. Right. So today you saw that China's manufacturing sector is booming, export sector is booming, but consumption and service sector activity has not even returned to pre-pandemic trend. And then it's actually those migrant workers, they are more concentrated in those service sector employment. So they are still suffering at this moment.
Good. I'm going to use my prerogative here and inject a question about which I'm really curious myself, and my students are very curious about, which is the recent tension over foreign initial public offerings. So firms in China that wish to obtain equity financing, for example, from the United States, there's been a lot of discussion from both sides, both the US authorities being very concerned about disclosure and the Chinese authorities being very concerned about the ability to control firms that are listing offshore, especially in the tech or data intensive areas. Maybe I'll start with Nick. Do you think that the ability of firms in China to raise equity funding offshore, first, is it in fact being hampered by regulatory limits, and secondly, if that's the case, is it a significant imposition on entrepreneurs in China, and does it cut back on China's growth?
Well, I would let Qian give a comprehensive answer on this, since she's in the securities business and I'm not, but I would just offer a couple of comments. First of all, the Chinese authorities are not completely cracking down on offshore US IPOs. They've said they're going to limit them in the case of companies that have a lot of data or national security implications. So some of those kinds of companies are not going to get approved. And then the US, of course, is threatening to delist these companies at some, 2 or 3 years down the road, if there's not more disclosure on their audit papers. So there are some bumps in the road, but in the short run, it's not a complete shutdown. The tougher question is, what does this mean for China and for entrepreneurs that want to raise money? I tend to take the view, years ago when Bank of China and these huge financial institutions were listing, the Chinese market was not deep enough to accommodate the kind of money that they expected to raise and were able to raise. But now the Chinese market is much bigger, the Hong Kong market is much bigger. So this idea that if they can't raise money in New York, they're going to fade away or shrivel on the vine, I think is not true. There's still some advantages of being listed in New York in terms of liquidity and so forth. But I think the Chinese market is able to do much larger IPOs than 10 years ago, and the Hong Kong market also.
Qian, your views, are companies able to get all the financing they need in Hong Kong, or is there a problem?
Well, I think, Hong Kong would definitely be an alternative, all right, at this moment. I think to a certain extent, I think Chinese companies still have incentive, right, to come to the US, to list, either for the greater liquidity, more flexible leading standard. And in economic terms, I think it's also a signaling effect, right? The requirement of higher transparency and corporate governance in the US would add credibility to that company and lower the cost of capital. However, as Nick mentioned, the regulatory uncertainty has indeed increased notably, right, for Chinese company on both sides, right? On the U.S. side, you just mentioned, the auditing requirement could actually, lead to a larger scale forced delisting if an agreement between the U.S. and China regulator cannot be reached in a timely manner. And even if there is a deal, the regulatory environment in the U.S. is also going to be much more stricter, right, for Chinese firms. Well, at the same time, Chinese government do see, U.S. listing, as a potential risk of data and national security risk. So I would say that both weaken the Chinese companies' incentive to come to the U.S. market. So that's why I think they are considering alternatives. Hong Kong will be a natural choice if they have to, go listed overseas, right? I mean, under the current regulation, for certain sectors, right, if you are going to invite foreign investors, you have to be listed, overseas. But given everything together, all the consideration, I wouldn't be surprised if the IPO pipeline, of Chinese company to the U.S. Will start to decline somewhat down the road.
Thanks, Nick. I want to come back to you on this. You've both you and Qian have mentioned that one of the issues is disclosure, but I watched a very amusing little video by the chairman of the United States Securities and Exchange Commission, Gary Gensler, in which he indicated he's concerned about a particular corporate governance structure called variable interest entity, or VIE, which seems to present potential investor protection concerns because these variable interest entities are effectively offshore consulting contracts that promise to pass on the dividends, but they're not really legal dividends. Then these consulting contracts could be canceled in principle if China forces these issuers of VIEs not to continue doing this. Do you think that this is a serious threat to U.S. investors, that these variable interest entities?
No, I don't. This has been the structure that has been used for decades. There's never been any problem. And the Chinese securities regulator a few weeks ago said that the variable interest entity structure will continue to be approved for offshore listings. So I think it's a good talking point for the head of the SEC to talk about, U.S. investors being vulnerable because of this structure. I think it's a red herring.
Well, that's pretty clear. I'm thinking, Mark, that we should give you the opportunity to close this session. If you have any closing questions or comments, and then wrap this up so that we can finish on time, because I know that you at SIEPR you keep an extremely tight time.
Yeah, we try to be respectful of everyone's time. We try to run a tight ship, but thank you to all three of you for an incredibly informative session on such an important part of the world, constantly changing. For me, from where I sit, it's often a little opaque. It's a little hard for me to understand what's going on in China. So to have three such knowledgeable individuals sharing their insights on it is really terrific. It was really interesting. And a gigantic thank you. Obviously, Darrell, you're just across the street from me here, but Qian and Nick as well. But we're going to move now into our exclusive session to continue speaking with all three of you. And this is for the supporters of SIEPR, so you know who you are. For those of you who aren't joining us for that, I hope you'll be back with us tomorrow, just a bit before 9 a.m. Pacific time. We're going to have a very busy day. We'll be hearing from U.S. Treasury Secretary Janet Yellen, the CEO of AMD, Lisa Su, Khan Academy founder Sal Khan, and many others. And we'll be running panels about the government response to the pandemic here in the U.S., the future of work, and much more. So thank you all so much again for being with us today, for sharing your insights, and for your engagement with SIEPR. And I really look forward to your joining us either right now at this next session or tomorrow morning. So thanks, everyone.
Thank you so much, Mark.
Thank you.